What if the number you have trusted your entire life is quietly becoming a lie? For decades, $1 million has been presented as a golden ticket to retirement, the milestone that separates stress from security, and the finish line that promises freedom after years of hard work. It sounds powerful, it sounds safe, and it feels like enough. But the uncomfortable truth is that numbers do not stand still while the world keeps moving. Inflation does not pause out of respect for your savings. Healthcare costs do not slow down because you worked overtime. Housing prices do not freeze because you hit a milestone. The economy evolves, markets shift, and purchasing power quietly erodes in the background, while most people continue aiming for a target that was set in a completely different era. If you believe that $1 million automatically guarantees comfort in retirement, you may be preparing for a future that no longer exists. Think about how different life looks today compared to just 20 years ago. Groceries cost more. Rent has surged in nearly every major city. Property values have climbed to levels that once seemed impossible, and medical expenses continue to rise faster than wages. Now imagine stretching those trends forward another decade, into 2035 and beyond. The math becomes unsettling. $1 million sitting in an account may look impressive, but what truly matters is what that money can buy. Retirement is not funded by a number on a screen. It is funded by purchasing power. And purchasing power is constantly under pressure. If inflation averages even a modest rate over the next 10 to 15 years, the real value of $1 million shrinks dramatically. What feels like financial independence today could feel like financial anxiety tomorrow. Most people underestimate how long retirement actually lasts. With increasing life expectancy, retiring at 65 could mean funding 25 or even 30 years of living expenses. That is 3 decades of housing, food, insurance, transportation, utilities, taxes, and unexpected emergencies. It is 3 decades of market fluctuations. It is 3 decades where healthcare becomes not just a line item, but potentially the largest expense of all. A single major medical event can cost hundreds of thousands of dollars. Long-term care can drain savings faster than most investment portfolios can replenish them. When you stretch $1 million across that timeline, especially while accounting for inflation, the margin for error becomes razor thin. There's also the psychological trap of round numbers. 1 million sounds complete. It feels like victory because it has been marketed as victory. But financial security is not about achieving a culturally popular number. It is about matching your resources to your lifestyle and the economic reality of your time. If your annual expenses in retirement are $70,000 and inflation continues to push that higher every year, your portfolio must sustain withdrawals while still growing enough to outpace rising costs. That balance becomes harder to maintain when returns are unpredictable and markets experience volatility. A few weak years early in retirement can permanently damage a portfolio if withdrawals remain constant. This is known as sequence risk, and it quietly destroys the plans of those who assume the market will always cooperate. Housing alone tells a powerful story. Property appreciation in many regions has outpaced wage growth for years. Even if you own your home outright, maintenance, property taxes, insurance, and repairs continue indefinitely. Roofs need replacement. Appliances fail. Neighborhoods change. If you rent in retirement, you are exposed directly to rising market rates. If you plan to relocate, you may find that desirable areas command premiums far higher than you anticipated. These realities compound over time, placing increasing pressure on a fixed retirement portfolio. Then there is the cost of simply living a meaningful life. Retirement is not meant to be survival mode. It is supposed to be freedom. It is travel, hobbies, supporting family, giving generously, and enjoying the time you worked so hard to earn. But every one of those experiences has a price tag attached, and those price tags rarely shrink. Airfare rises. Entertainment costs increase. Even basic services adjust upward with inflation. If your retirement plan only accounts for essentials and leaves no margin for joy, then the number you reach was never truly enough to begin with. The real danger is not that $1 million is worthless. It is that it may create a false sense of completion. When people believe they have reached the summit, they often stop climbing. They slow their savings rate. They reduce their investment contributions. They assume the hardest part is over. Meanwhile, the economic landscape keeps shifting beneath their feet. By the time reality catches up, adjusting becomes much more difficult. The earlier you recognize that the benchmark may be outdated, the more time you have to adapt, increase contributions, invest strategically, and build a buffer that protects against uncertainty. Retirement planning is no longer about hitting a symbolic milestone. It is about building resilience. It is about understanding that the future will likely cost more than the present. It is about preparing not just for average outcomes, but for worst-case scenarios. Because when you remove the illusion and look at the numbers through the lens of inflation, longevity, healthcare, and lifestyle expectations, $1 million stops looking like a finish line and starts looking like a starting point. If that realization feels uncomfortable, it should, because comfort is often the enemy of preparation, and preparation is a foundation of financial survival in a changing economy. The real question is not whether $1 million sound impressive, but whether it will function as a shield against the economic forces that are already accelerating. When we project forward to 2035 and even into 2050, we are not guessing blindly. We are observing patterns that have repeated for decades. Inflation compounds quietly. Healthcare expenses rise faster than general consumer prices, and asset values, especially in desirable areas, continue climbing as demand outpaces supply. When these forces combine, they create a gap between what people believe they will need and what they will actually require. That gap is where retirement plans collapse. Imagine waking up in 2035 with $1 million invested, believing you have done everything right. On paper, you follow the traditional advice. You save consistently, invested in diversified funds, avoided unnecessary debt, and waited patiently. But the world around you has changed more than you expected. Annual living expenses that once required $60,000 now require $90,000 or more. Insurance premiums have doubled. Property taxes have adjusted upward with rising valuations. Medical costs demand larger out-of-pocket payments. Even groceries consume a noticeably bigger portion of your monthly budget. Suddenly, your withdrawal rate creeps higher than the recommended safe threshold. Instead of withdrawing 4% annually, you are withdrawing closer to 7 or 8% just to maintain a modest lifestyle. That difference may seem small at first, but over a 25-year retirement, it can mean the difference between stability and depletion. This is where the suspense builds, because most people will not notice the danger immediately. The first few years may feel manageable. Markets may perform well. Your account balance may even grow despite withdrawals. That creates confidence. Confidence turns into complacency. Complacency delays adjustment. Then, without warning, a market downer arrives at the worst possible time. Your portfolio declines by 20 or 30% in a single year. Yet your expenses remain fixed or even increase. You are forced to withdraw funds from a shrinking base, locking in losses. The compounding that once worked in your favor now works against you. This is the silent risk of relying on outdated benchmarks. It is not dramatic at first. It is gradual, subtle, and then suddenly urgent. Graham Stephan says that numbers should never be viewed in isolation, and that advice becomes critical when planning for retirement in an evolving economy. $1 million meant something different 20 years ago than it will mean 10 years from now. Purchasing power is the true metric, not the headline amount. When inflation averages even 3 to 4% over time, the cumulative effect over 15 years is substantial. $1 in 2035 will likely buy significantly less than $1 today. That erosion does not make headlines every day, but it steadily reshapes what financial independence actually costs. If your retirement strategy is built around a static number, while expenses are dynamic, the math will eventually expose imbalance. Healthcare alone introduces enormous uncertainty. Medical innovation extends life expectancy, which is a gift, but longer life also means longer financial responsibility. Prescription costs, specialized treatments, long-term care facilities, and in-home assistance are rarely inexpensive. Even with insurance coverage, deductibles and co-payments can accumulate rapidly. A single prolonged health event can consume hundreds of thousands of dollars. When planners model retirement scenarios, they often use average healthcare costs. But retirement rarely unfolds as an average experience. It unfolds through real events, unexpected diagnoses, and changing physical needs. If your plan barely survives the average scenario, it may not withstand a challenging one. Housing and lifestyle expectations further complicate the picture. Many retirees envision downsizing as a solution, but in high-demand markets, smaller homes can still command premium prices. Additionally, the emotional cost of relocating away from family or community is not easily quantified. Some retirees choose to remain in their homes, only to discover that maintenance expenses increase with age. Roof replacements, plumbing repairs, electrical updates, landscaping, and accessibility modifications all require capital. These costs do not disappear after the mortgage is paid off. They persist, often unpredictably. As we move toward 2035, technological change may also reshape expenses in unexpected ways. New services, subscriptions, digital platforms, and evolving standards of living can subtly increase baseline costs. What was once considered a luxury becomes a necessity. High-speed connectivity, advanced healthcare monitoring, upgraded transportation options, and security services may all become part of everyday life. The definition of a comfortable retirement evolves with society. If your financial plan is rooted in yesterday's definition of comfort, you risk underestimating tomorrow's reality. This is why the concept of a $3 million retirement fund begins to surface not as extravagance, but as insulation. When you triple the benchmark, you create margin. Margin absorbs volatility. Margin protects against sequence risk. Margin allows you to maintain a reasonable withdrawal rate even during downturns. Most importantly, margin provides peace of mind. Financial independence is not only about surviving mathematically, it is about living without constant fear of running out. If the goal of retirement is freedom, then the number must reflect the true cost of sustaining that freedom in a future shaped by inflation, longevity, and evolving expectations. So the question is no longer whether $1 million sound impressive, but whether you are willing to adapt before the world forces you to. The future does not reward those who cling to outdated milestones. It rewards those who respond early, think critically, and position themselves ahead of economic shifts. If $3 million becomes a new standard by 2035, it will not happen overnight. It will happen gradually, through compounding inflation, rising healthcare obligations, increasing asset prices, and longer lifespans. The advantage belongs to those who recognize the shift while there is still time to respond. Because here is the empowering truth hidden inside the warning. You are not powerless. You are early. The difference between someone who struggles in retirement and someone who thrives often comes down to preparation years before retirement ever begins. Increasing your savings rate today may feel uncomfortable, but discomfort is temporary, while financial security can last a lifetime. Adjusting your investment strategy to prioritize growth assets over excessive conservatism during your accumulation phase can dramatically change your long-term outcome. Many people underestimate how powerful consistent investing becomes when given enough time. Compounding is not dramatic at first, but it becomes unstoppable when paired with discipline. A portfolio that grows at an average annual rate that slightly outpaces inflation can create exponential results over decades. That is how 2 million becomes 3. That is how 3 becomes 4. It also requires clarity about your future lifestyle. Retirement planning cannot be vague. It cannot rely on hope. You must calculate realistic annual expenses, stress test them against higher inflation scenarios, and model what happens if markets underperform for several years in a row. This is not pessimism. It is strategic foresight. When you assume conservative returns and higher expenses, you build resilience. When reality turns out better than expected, you gain surplus. But if you assume perfection and reality delivers volatility, the consequences are far more painful. Financial planning is not about predicting exact outcomes. It is about preparing for a range of them. There is also a mindset shift required. Instead of aiming for the minimum required to retire, aim for the maximum flexibility. Flexibility means having the option to retire earlier, reduce work gradually, or pursue passion projects without financial pressure. It means being able to support family members if needed. It means absorbing unexpected expenses without panic. That flexibility is built through higher savings, diversified investments, and multiple income streams. Passive income, whether through dividend-producing assets, rental properties, or business ownership, creates an additional layer of security. When your money generates income beyond simple portfolio withdrawals, you reduce dependence on selling assets during downturns. That structural advantage can preserve wealth across decades. Discipline must replace complacency. It is easy to celebrate hitting a seven-figure net worth. It is harder to continue pushing forward when society tells you that you have already won. But true financial independence is not about applause. It is about endurance. If inflation averages 3 to 4% and healthcare costs rise even faster, then standing still financially is equivalent to moving backward. Your strategy must outpace the erosion. That may mean negotiating higher income during your career, developing new skills that increase your earning potential, or creating side ventures that supplement your investments. Every additional dollar invested today carries amplified impact tomorrow. At the same time, balance is critical. Preparing for a $3 million retirement does not mean sacrificing all joy in the present. It means intentional allocation. It means understanding that every dollar has a purpose, either funding your current lifestyle or your future freedom. When you spend consciously and invest aggressively within your means, you align your actions with long-term independence. Small habits compound just as powerfully as investment returns. Automating contributions, avoiding lifestyle inflation as income rises, and reinvesting windfalls rather than upgrading consumption can accelerate progress dramatically. The earlier you begin adjusting your trajectory, the less drastic the changes need to be. The most powerful realization is that retirement is not a fixed destination. It is a moving target influenced by economic forces beyond your control. But while you cannot control inflation or global markets, you can control your response. You can increase your margin. You can raise your standards. You can refuse to rely on outdated assumptions. By aiming higher than the traditional $1 million benchmark, you create breathing room for uncertainty. You transform fear into strategy. You replace hope with preparation. The $3 million reality by 2035 is not about fear-mongering. It is about clarity. It is about acknowledging that the economy of tomorrow will not mirror the economy of yesterday. Those who adapt will experience retirement as freedom, opportunity, and peace of mind. Those who delay may find themselves forced back into the workforce or compromising the lifestyle they once envisioned. The decision is being made today through daily financial choices that seem small but accumulate into massive outcomes over time. You have the ability to rewrite your retirement narrative before it is written for you. Increase your awareness. Strengthen your strategy. Challenge the assumptions you inherited. Build beyond the minimum. Because financial independence in a changing economy belongs to those who prepare for reality, not nostalgia. And if you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.